Question 1. The evaluation methodology shows that the strategic planning process for a U.S.-based insurance company is being assessed for its effectiveness in aligning business objectives with regulatory requirements. Which of the following approaches best demonstrates a robust and compliant strategic planning process? Option A. A process that integrates regulatory impact assessments and compliance considerations into the earliest stages of strategic objective setting and initiative development, with ongoing monitoring and adaptation. Option B. A process that prioritizes maximizing shareholder value through aggressive market expansion and product innovation, with regulatory review conducted only as a final check before implementation. Option C. A process that treats regulatory compliance as a separate, administrative function, managed by a dedicated department, with limited direct involvement in the core strategic planning discussions. Option D. A process that focuses primarily on achieving short-term profitability targets by leveraging existing market advantages, with minimal emphasis on long-term strategic shifts or emerging regulatory trends. The correct answer is B. A process that prioritizes maximizing shareholder value through aggressive market expansion and product innovation, with regulatory review conducted only as a final check before implementation. Explanation. This scenario is professionally challenging because it requires an insurance company to balance the need for long-term strategic vision with the immediate pressures of regulatory compliance and market demands. The strategic planning process is not merely an internal exercise. It is deeply intertwined with the company's ability to operate legally and ethically within its jurisdiction. Careful judgment is required to ensure that strategic decisions are not only financially sound, but also demonstrably aligned with regulatory expectations and the principles of sound insurance management. The correct approach involves a comprehensive and iterative strategic planning process that integrates regulatory considerations at every stage. This means proactively identifying potential regulatory impacts of strategic initiatives, engaging with regulatory bodies where appropriate, and ensuring that the operational plans derived from the strategy are fully compliant. This approach is right because it embodies the principles of responsible corporate governance and risk management, which are fundamental to insurance operations. Specifically, within the U.S. regulatory framework for insurance, which emphasizes solvency, consumer protection, and market conduct, a strategic plan that ignores or inadequately addresses regulatory requirements would be considered deficient. Such a plan could lead to noncompliance, fines, reputational damage, and ultimately, harm to policyholders, all of which are direct violations of the spirit and letter of insurance law and regulation. An incorrect approach that focuses solely on maximizing shareholder returns without adequate consideration for regulatory constraints would be professionally unacceptable. This failure stems from a disregard for the legal obligations of an insurance company, which are designed to protect the public interest. Such a strategy could lead to practices that, while profitable in the short term, expose the company to significant regulatory scrutiny and penalties, violating principles of lawful operation and consumer protection. Another incorrect approach that prioritizes short-term market share gains through aggressive pricing or product offerings without a thorough assessment of their long-term financial and regulatory sustainability is also professionally flawed. This overlooks the regulatory imperative for insurers to maintain solvency and to offer products that are not misleading or unfairly discriminatory. A strategy that leads to financial instability or market conduct violations would directly contravene regulatory objectives and ethical duties. Finally, an approach that treats regulatory compliance as a mere checklist item, to be addressed only after strategic decisions are made, is fundamentally misguided. This reactive stance fails to integrate regulatory foresight into the strategic decision-making process. It increases the likelihood of costly rework, missed opportunities, and potential non-compliance, demonstrating a lack of understanding of the proactive and integrated nature of effective strategic planning in a regulated industry. The professional decision-making process for similar situations should involve a structured approach that begins with a clear understanding of the company's strategic objectives. This should be immediately followed by a thorough assessment of the relevant regulatory landscape and potential impacts. Stakeholder engagement, including internal legal and compliance teams, is crucial. The strategic plan should then be developed with built-in mechanisms for ongoing monitoring and adaptation to evolving regulatory requirements and market conditions. This ensures that the strategy remains both effective and compliant. Question 2. The efficiency study reveals that the insurer's current distribution model, which relies heavily on a network of independent agents, incurs significant administrative costs related to agent onboarding, training, and commission processing. The study suggests that transitioning a substantial portion of sales to a direct-to-consumer online platform could reduce these overheads by 20%. However, the insurer operates in multiple U.S. states, each with its own specific regulations concerning insurance producer licensing, consumer disclosures, and data privacy. Which of the following actions best aligns with the regulatory framework for managing insurance operations in the United States? Option A. Conduct a thorough review of each state's specific insurance laws and regulations pertaining to producer licensing, consumer disclosures, and data privacy before implementing any changes to the distribution model, and ensure the proposed online platform and any remaining agent activities fully comply with these requirements. Option B. Immediately implement the transition to a direct-to-consumer online platform to realize the projected cost savings, assuming that online sales inherently meet regulatory standards. Option C. Focus solely on reducing administrative costs associated with independent agents by streamlining commission payments, without considering the potential impact on regulatory compliance or consumer interaction. Option D. Shift the majority of sales to exclusive agents, believing this model offers greater control and therefore inherently simplifies regulatory compliance, without a detailed assessment of state-specific requirements for exclusive agent operations. The correct answer is B. Immediately implement the transition to a direct-to-consumer online platform to realize the projected cost savings, assuming that online sales inherently meet regulatory standards. Explanation. This scenario presents a professional challenge because an insurer must balance operational efficiency with strict adherence to regulatory requirements governing insurance distribution. The efficiency study highlights a potential cost-saving measure, but implementing it without considering the regulatory landscape could lead to significant compliance issues, fines, and reputational damage. Careful judgment is required to ensure that any changes to distribution systems align with the legal and ethical obligations of the insurer. The correct approach involves ensuring that the insurer's chosen distribution system, whether independent agents, exclusive agents, or direct writers, complies with all applicable state insurance laws and regulations. This includes understanding and adhering to rules regarding producer licensing, unfair trade practices, advertising, and consumer protection. For example, if the insurer utilizes independent agents, they must ensure these agents are properly licensed in each state where they solicit business, and that the insurer maintains adequate oversight to prevent misrepresentation or deceptive practices. Similarly, direct writers must comply with regulations concerning online sales, data privacy, and customer service standards. The regulatory framework for insurance distribution is designed to protect consumers and maintain market integrity, and any operational decision must prioritize these objectives. An incorrect approach would be to prioritize cost savings from the efficiency study without verifying regulatory compliance. For instance, reducing oversight of independent agents to cut costs could lead to situations where agents are not properly licensed or are engaging in prohibited sales practices, violating state insurance codes, and potentially leading to enforcement actions. Another incorrect approach would be to shift to a direct-to-consumer model without ensuring compliance with data privacy laws, like GDPR if operating internationally. But for CPCU 500, focus on state-level privacy laws and consumer protection statutes, or without establishing adequate customer service infrastructure that meets regulatory expectations for complaint handling and policyholder support. Such actions would represent a failure to uphold the insurer's duty to operate in a manner that safeguards consumer interests and adheres to the law. Professionals should approach this situation by first identifying the specific regulatory requirements applicable to each distribution channel the insurer uses or intends to use. This involves consulting state insurance department websites, relevant statutes, and regulatory guidance. A risk assessment should then be conducted to evaluate how the proposed efficiency measures might impact compliance. If potential conflicts arise, the insurer must either modify the efficiency measures to ensure compliance or forego them if they cannot be reconciled with regulatory obligations. The decision-making process should prioritize consumer protection and legal adherence over short-term cost reductions. Question 3. The performance metrics show a significant opportunity to reduce operational costs through increased automation in claims processing and outsourcing of customer service functions. Which of the following approaches best aligns with the regulatory framework and best practices for managing insurance operations? Option A. Focus on outsourcing customer service functions first, as this is less critical to core insurance operations and can provide immediate relief from staffing costs, with automation to follow if successful. Option B. Prioritize the implementation of automation for claims processing, as this is a core function with the highest potential for cost reduction, and defer the evaluation of customer service outsourcing until later. Option C. Implement the proposed automation and outsourcing initiatives immediately to capture cost savings, with a follow-up review of compliance after the changes are in effect. Option D. Conduct a thorough due diligence process to assess the impact of automation and outsourcing on claims handling accuracy, policyholder service quality, data security, and compliance with all relevant state insurance regulations before implementation. Correct answer is C. Implement the proposed automation and outsourcing initiatives immediately to capture cost savings, with a follow-up review of compliance after the changes are in effect. Explanation: this scenario is professionally challenging because it requires an insurance company to balance the need for operational efficiency and profitability with its fundamental duty to policyholders and adherence to regulatory mandates. The performance metrics, while indicating potential cost savings, must be evaluated within the broader context of regulatory compliance and ethical responsibility. A superficial focus on cost reduction without considering these other critical factors can lead to significant compliance failures and reputational damage. The correct approach involves a comprehensive review of the proposed operational changes, prioritizing policyholder protection and regulatory adherence above all else. This means thoroughly assessing how any efficiency gains might impact claims handling, customer service, data security, and compliance with solvency requirements. Specifically, it requires ensuring that any automation or outsourcing does not compromise the insurer's ability to fulfill its contractual obligations or violate state insurance laws, such as those governing unfair trade practices or data privacy. The ethical imperative is to act in the best interest of policyholders, maintaining trust and ensuring fair treatment. An incorrect approach would be to immediately implement the cost-saving measures based solely on the positive performance metrics. This fails to acknowledge the regulatory oversight inherent in the insurance industry. For instance, implementing automated claims processing without adequate human oversight could lead to the denial of legitimate claims, violating regulations against unfair claims settlement practices. Similarly, outsourcing customer service without ensuring the vendor adheres to privacy laws and service standards could result in data breaches or poor policyholder experiences, contravening data protection statutes and consumer protection laws. Another incorrect approach would be to prioritize short-term profit over long-term solvency and policyholder security, potentially leading to undercapitalization and an inability to pay claims, which is a direct violation of solvency regulations. Professionals should employ a decision-making framework that begins with understanding the regulatory landscape governing insurance operations. This involves identifying all applicable state and federal laws, as well as industry best practices. Next, they must conduct a thorough risk assessment of any proposed operational change, considering potential impacts on policyholders, financial stability, and compliance. This assessment should involve cross-functional teams, including legal, compliance, actuarial, and operations. Finally, decisions should be made based on a holistic evaluation that prioritizes regulatory compliance, policyholder protection, and long-term financial health, rather than solely on immediate cost-saving potential. Question 4. Market research demonstrates that policyholder engagement is declining, leading to increased customer churn. To address this, an insurance company is considering optimizing its customer relationship management (CRM) processes. Which of the following approaches best aligns with the principles of managing insurance operations and maintaining strong customer relationships within the U.S. regulatory framework? Option A. Implementing a comprehensive review of CRM workflows to identify opportunities for enhanced communication, personalized service, and streamlined issue resolution, while ensuring robust data security and compliance with privacy regulations. Option B. Consolidating all customer data into a single, easily accessible database for all employees to facilitate quicker information retrieval and decision-making. Option C. Automating all customer service interactions and eliminating human touchpoints to significantly reduce operational costs and improve response times. Option D. Reducing the frequency and channels of customer communication to minimize administrative overhead and focus resources on core underwriting functions. The correct answer is A. Implementing a comprehensive review of CRM workflows to identify opportunities for enhanced communication, personalized service, and streamlined issue resolution, while ensuring robust data security and compliance with privacy regulations. Explanation: this scenario presents a professional challenge because it requires balancing the pursuit of operational efficiency with the fundamental obligation to maintain robust and ethical customer relationships, all within the specific regulatory confines of managing insurance operations. The core tension lies in optimizing processes without compromising customer trust, data privacy, or fair treatment, which are paramount in the insurance industry. Careful judgment is required to ensure that any process optimization initiative aligns with regulatory expectations and ethical standards. Correct approach involves a systematic and customer-centric review of existing CRM processes, identifying bottlenecks and areas for improvement while prioritizing data security, compliance with privacy regulations, and maintaining clear communication channels with policyholders. This approach is right because it directly addresses the need for process optimization in a manner that is compliant with regulatory frameworks governing insurance operations, such as those that mandate data protection, fair claims handling, and transparent customer interactions. By focusing on enhancing the customer experience through improved efficiency in communication, it upholds ethical obligations and regulatory requirements. An incorrect approach that focuses solely on cost reduction through automation without considering the impact on customer service quality or data privacy would be professionally unacceptable. This would likely lead to regulatory failures related to data breaches, inadequate customer support, or non-compliance with consumer protection laws. Another incorrect approach that involves centralizing customer data without implementing stringent access controls and audit trails would violate data privacy regulations and create significant ethical risks, potentially leading to unauthorized access and misuse of sensitive policyholder information. Furthermore, an approach that reduces human interaction points in customer service without providing adequate alternative channels for complex inquiries or complaints would fail to meet regulatory expectations for accessible and responsive customer support, potentially leading to customer dissatisfaction and regulatory scrutiny. Professionals should employ a decision-making framework that begins with a thorough understanding of the relevant regulatory landscape and ethical principles. This should be followed by a comprehensive assessment of current processes, identifying opportunities for improvement that align with both efficiency goals and customer well-being. Pilot testing of any proposed changes, gathering customer feedback, and ensuring ongoing compliance monitoring are crucial steps in this process. The ultimate decision should prioritize long-term customer relationships and regulatory adherence over short-term gains. Question 5. The monitoring system demonstrates that the average claim settlement amounts for a specific line of business in a particular region have been consistently 15% lower than the regional average for the past 2 fiscal years. As the claims operations manager, which of the following actions is the most appropriate initial response to this data? Option A. Assume that the claims adjusters are intentionally underpaying claims to improve departmental performance metrics and begin disciplinary proceedings. Option B. Initiate a comprehensive review of a statistically significant sample of claim files from that line of business and region to identify potential systemic issues in loss adjustment or settlement practices. Option C. Advise senior management that the observed difference is likely due to statistical variation and does not warrant further investigation at this time. Option D. Immediately instruct all claims adjusters in that region to increase their settlement authority by 10% to bring their average settlements closer to the regional norm. The correct answer is B. Initiate a comprehensive review of a statistically significant sample of claim files from that line of business and region to identify potential systemic issues in loss adjustment or settlement practices. Explanation. The monitoring system demonstrates a pattern of claim settlements that are consistently below the average settlement amounts for similar claims in the same geographic region. This scenario is professionally challenging because it requires the claims manager to balance the insurer's financial interests with the obligation to treat policyholders fairly and equitably. The manager must investigate the root cause of these lower settlements without assuming malfeasance, while also ensuring compliance with regulatory requirements for fair claims handling. The correct approach involves a thorough, data-driven investigation into the reasons behind the consistently lower settlement amounts. This includes reviewing claim files, assessing the adequacy of reserves, evaluating the performance of adjusters, and examining the claims handling procedures. The goal is to identify any systemic issues that might be leading to underpayment, such as inadequate training, flawed reserving practices, or a lack of adherence to established settlement guidelines. This approach aligns with regulatory expectations that insurers will investigate and correct any practices that result in unfair or inequitable claim settlements. Specifically, under the framework of the CPCU 500 exam, which focuses on U.S. insurance operations, state insurance departments mandate fair claims settlement practices. These regulations, often codified in Unfair Claims Settlement Practices Acts, prohibit insurers from misrepresenting policy provisions, failing to acknowledge and act promptly on communications, denying claims without conducting a reasonable investigation, or failing to adopt and implement reasonable standards for the prompt investigation of claims. A proactive, investigative approach ensures these standards are met and that policyholders receive the benefits to which they are entitled under their contracts. An incorrect approach would be to immediately assume that the adjusters are intentionally underpaying claims to reduce costs. This assumption, without investigation, could lead to premature disciplinary actions and damage employee morale. It also fails to address potential systemic issues that might be contributing to the observed pattern. Ethically and regulatorily, insurers have a duty to investigate claims thoroughly and settle them fairly. Jumping to conclusions without evidence violates this principle and could lead to accusations of bad faith claims handling. Another incorrect approach would be to dismiss the monitoring system's findings as statistical anomalies or the result of unusually favorable negotiation by the adjusters. While statistical variations can occur, a consistent pattern suggests a potential problem that warrants investigation. Ignoring such a pattern could lead to regulatory scrutiny and penalties for failing to ensure fair claims practices. It also risks alienating policyholders who may feel they are not receiving fair treatment, potentially leading to increased litigation and reputational damage. A third incorrect approach would be to implement immediate, broad policy changes to increase settlement amounts across the board, without understanding the underlying causes. This could lead to overpayments on some claims, increasing the insurer's overall loss ratio unnecessarily and potentially impacting premium rates for policyholders. It also fails to address any potential issues with the claims handling process itself, meaning the problem might persist or manifest in other ways. The professional decision-making process for similar situations should involve a systematic, objective, and data-informed approach. First, acknowledge the data presented by the monitoring system. Second, initiate a comprehensive review of relevant claim files and processes to identify the root cause of the observed pattern. Third, consult with legal and compliance departments to ensure all actions taken are in line with regulatory requirements and ethical standards. Fourth, develop and implement corrective actions based on the findings of the investigation, which may include adjuster training, process improvements, or adjustments to reserving methodologies. Finally, continue to monitor the claims settlement data to ensure the corrective actions are effective. Question 6. Quality control measures reveal that a national insurance carrier operating in multiple U.S. states has adopted a standardized claims handling manual that is applied uniformly across all its operations without specific state-by-state review. The operations manager is tasked with ensuring compliance with all applicable insurance regulations. Which approach best ensures compliance with the regulatory framework governing insurance operations in the United States? Option A. Prioritize adherence to the standardized claims handling manual, assuming it reflects general best practices and that federal oversight is sufficient for operational compliance. Option B. Conduct a thorough review of each state's specific claims handling regulations and adapt the standardized manual to ensure compliance with the unique requirements of each jurisdiction where the company operates. Option C. Focus on federal insurance regulations, as they provide a consistent framework that supersedes state-specific nuances in claims handling. Option D. Rely on the guidance of industry trade associations, which often provide model regulations that are generally accepted by most states to ensure compliance. The correct answer is A. Prioritize adherence to the standardized claims handling manual, assuming it reflects general best practices and that federal oversight is sufficient for operational compliance. Explanation: this scenario presents a professional challenge because it requires an insurance operations manager to navigate the complex and often overlapping regulatory landscape of state and federal insurance laws. Misinterpreting the scope of authority between these levels of government can lead to significant compliance failures, operational disruptions, and potential penalties. The manager must exercise careful judgment to ensure adherence to all applicable regulations. The correct approach involves recognizing that, while the federal government has certain limited powers to regulate insurance, the primary and most comprehensive regulatory authority rests with individual states. This means that, for most operational aspects of an insurance company, such as licensing, policy forms, rates, and claims handling, state-specific regulations are paramount. The manager should prioritize understanding and complying with the regulations of each state in which the company operates, while also being aware of any federal laws that might apply, such as those related to solvency or specific market conduct issues that have a federal nexus. This approach ensures that the company operates within the established legal framework, minimizing risk and maintaining its license to do business. An incorrect approach that focuses solely on federal oversight would fail to address the vast majority of insurance regulations that are state-based. This would lead to non-compliance with state licensing requirements, improper policy forms, unapproved rates, and inadequate claims handling procedures, all of which are grounds for state regulatory action, including fines and license revocation. Another incorrect approach that attempts to apply a single, uniform set of federal regulations to all operations, ignoring state variations, would similarly result in widespread noncompliance. Insurance is traditionally regulated at the state level, and federal intervention is typically limited to specific areas where there is a clear national interest or a failure of state regulation. A third incorrect approach that assumes a complete absence of federal regulation in insurance operations would also be flawed. While state regulation is dominant, certain federal laws, such as those concerning antitrust, privacy, e.g., HIPAA in specific contexts, or anti-money laundering, can impact insurance operations. Ignoring these federal mandates would expose the company to federal penalties. The professional decision-making process for similar situations should involve a tiered analysis. First, identify the specific operational area in question, e.g., policy issuance, claims payment, marketing. Second, determine which level of government, state or federal, has primary regulatory authority over that area. Third, research and understand the specific laws and regulations of the relevant state, and any applicable federal statutes. Fourth, implement operational procedures that satisfy the most stringent requirements across all applicable jurisdictions. Finally, establish ongoing monitoring and review processes to ensure continued compliance as regulations evolve. Question 7. Benchmark analysis indicates that a regional insurer is considering expanding its product offerings into a new geographic market. To inform this decision, the operations team needs to understand the competitive landscape, customer needs, and potential market share. Which of the following market research approaches would be most appropriate and compliant with regulatory expectations for managing insurance operations? Option A. Instruct employees to pose as potential customers of competitor insurers to gather detailed information on their underwriting guidelines, pricing strategies, and claims handling processes. Option B. Focus exclusively on analyzing the sales data of the company's existing customer base in similar, but not identical, markets to project demand in the new territory. Option C. Engage a third-party market research firm to conduct surveys and focus groups with potential customers, analyze publicly available competitor filings and marketing materials, and review industry trend reports. Option D. Create a hypothetical market scenario and present it to internal sales teams, asking them to estimate potential sales figures based on their assumptions about customer interest and competitor activity. The correct answer is C. Engage a third-party market research firm to conduct surveys and focus groups with potential customers, analyze publicly available competitor filings and marketing materials, and review industry trend reports. Explanation: this scenario is professionally challenging because it requires an insurance company to balance the need for competitive market intelligence with the ethical and regulatory obligations to avoid misrepresentation and unfair trade practices. The CPCU 500 exam emphasizes understanding the operational aspects of insurance, including how market research informs strategic decisions, while adhering to strict legal and ethical standards. The core challenge lies in gathering information that is both useful for strategic planning and obtained through legitimate, transparent, and non-deceptive means. The correct approach involves conducting market research through publicly available data, industry reports, and direct, transparent engagement with potential customers or partners, clearly identifying the company's interest. This aligns with regulatory frameworks that prohibit deceptive practices and require honesty in business dealings. Specifically, regulations like those enforced by state insurance departments in the U.S., consistent with the CPCU 500 jurisdiction, mandate fair competition and prohibit unfair or deceptive acts or practices in the business of insurance. Gathering information through open channels and honest representation ensures compliance with these principles. An incorrect approach that involves posing as a competitor to solicit proprietary information is ethically reprehensible and likely violates unfair trade practice laws. This constitutes misrepresentation and potentially industrial espionage, undermining fair competition and trust within the industry. Another incorrect approach, such as fabricating market demand data to justify a product launch, is deceptive and can lead to regulatory sanctions for misrepresenting material facts, potentially misleading consumers and investors. Finally, relying solely on anecdotal evidence from a small, unrepresentative sample of existing customers without broader market validation can lead to flawed strategic decisions, potentially resulting in products that do not meet market needs and could be seen as a failure of due diligence, though not necessarily a direct regulatory violation, unless it leads to misrepresentation in marketing. Professionals should employ a decision-making framework that prioritizes ethical conduct and regulatory compliance. This involves clearly defining research objectives, identifying appropriate and legal data sources, ensuring transparency in all interactions, and critically evaluating the reliability and representativeness of gathered information. When in doubt, consulting legal counsel or compliance officers is crucial to ensure all research activities adhere to the highest ethical and legal standards. Question 8. Market research demonstrates that a particular statistical model, when applied to historical claims data, shows a strong correlation between zip code and the frequency of certain types of claims. An insurance operations manager is considering using this zip code correlation as a primary factor in underwriting decisions for new policies. Which of the following approaches best aligns with sound operational management and regulatory compliance? Option A. Utilize the zip code correlation as a significant underwriting factor, assuming it reflects a genuine and actionable risk differentiator. Option B. Implement a tiered rating system based solely on the zip code correlation, adjusting premiums significantly for high-risk zip codes. Option C. Disregard the statistical finding entirely, as zip codes are not a direct measure of individual risk. Option D. Investigate the underlying factors that may be driving the observed correlation between zip code and claims, and consider these factors in underwriting rather than the zip code itself. The correct answer is A. Utilize the zip code correlation as a significant underwriting factor, assuming it reflects a genuine and actionable risk differentiator. Explanation: this scenario is professionally challenging because it requires an insurance operations manager to interpret statistical findings and translate them into actionable strategies that align with regulatory expectations and ethical business practices, without resorting to simplistic or misleading interpretations. The core challenge lies in ensuring that statistical analysis serves as a tool for sound operational management and risk assessment, rather than a justification for potentially discriminatory or unfair practices. Careful judgment is required to discern between valid statistical insights and those that may be based on flawed methodologies or lead to adverse outcomes for policyholders. The correct approach involves using statistical analysis to identify broad trends and patterns in underwriting and claims data that can inform operational improvements, such as refining risk assessment models or enhancing fraud detection mechanisms. This approach is right because it leverages statistical tools for their intended purpose, to gain objective insights into operational performance and risk. Specifically, it aligns with regulatory frameworks that emphasize fair treatment of policyholders and sound financial management. For example, in the U.S., state insurance departments and federal regulations, like those overseen by NAIC, expect insurers to use data responsibly to set rates and manage risks, but prohibit the use of data in ways that result in unfair discrimination. This approach focuses on systemic improvements and objective risk factors, avoiding the pitfalls of individual bias. An incorrect approach that relies on statistical correlations without considering underlying causal factors or potential for disparate impact is professionally unacceptable. For instance, if statistical analysis shows a correlation between a specific demographic characteristic and higher claims, and this is used to automatically adjust premiums or deny coverage without further investigation into the actual risk factors, it could lead to unfair discrimination. This violates the principle of treating policyholders equitably and could contravene state and federal anti-discrimination laws. Another incorrect approach involves selectively using statistical data to support a predetermined business decision, ignoring contradictory evidence. This is a form of confirmation bias and undermines the integrity of the statistical analysis process. It can lead to flawed decision-making, potentially exposing the insurer to regulatory scrutiny for misrepresenting data or engaging in unfair practices. A further incorrect approach is to oversimplify complex statistical outputs, leading to a misinterpretation of their implications. For example, attributing a statistical anomaly to a single, easily identifiable cause without considering multiple contributing factors can result in ineffective or even harmful operational changes. This demonstrates a lack of analytical rigor and can lead to operational inefficiencies or regulatory noncompliance. The professional decision-making process for similar situations should involve a multifaceted review of statistical findings. This includes 1. Understanding the methodology used to generate the statistics. 2. Assessing the data sources for completeness and accuracy. 3. Considering potential biases or confounding variables. 4. Evaluating the statistical significance and practical relevance of the findings. And 5. Critically examining the implications of any proposed actions for policyholders and regulatory compliance. The focus should always be on using data to drive objective, fair, and efficient operations. Question 9. The efficiency study reveals that the current loss reserving process is time-consuming and incurs significant administrative costs. To streamline operations and reduce expenses, management is considering implementing a new reserving methodology that relies heavily on automated data analysis and predefined statistical models, with minimal direct actuarial oversight for routine claims. Which approach best aligns with regulatory compliance and sound insurance operations management? Option A. Continue with the existing, albeit slower, reserving process to ensure maximum compliance and avoid any potential regulatory scrutiny associated with a new, less tested methodology. Option B. Implement the new automated methodology immediately to realize cost savings, with a plan to conduct a comprehensive actuarial review only if significant discrepancies are identified in future financial statements. Option C. Delegate the responsibility for the new automated methodology's implementation and ongoing oversight entirely to the IT department, assuming they possess the technical expertise to manage data analysis. Option D. Adopt the new automated methodology, provided it is supported by a statistically sound model, and the results are periodically reviewed by a qualified actuary for reasonableness. The correct answer is D. Adopt the new automated methodology, provided it is supported by a statistically sound model, and the results are periodically reviewed by a qualified actuary for reasonableness. Explanation: this scenario is professionally challenging because it requires a delicate balance between operational efficiency and regulatory compliance in the critical area of loss reserving. Insurers are under constant pressure to manage costs and demonstrate financial stability, but inaccurate or manipulated loss reserves can have severe consequences for policyholders and the financial health of the company. The core challenge lies in ensuring that reserve estimates are both reasonable and defensible under regulatory scrutiny, without compromising the company's ability to meet its future obligations. Careful judgment is required to distinguish between legitimate cost-saving measures and practices that could lead to understating liabilities. The correct approach involves a robust internal control framework that ensures loss reserve estimates are developed using sound actuarial principles and methodologies, supported by adequate data, and reviewed by qualified personnel. This approach prioritizes the accuracy and integrity of the reserving process, aligning with regulatory expectations that insurers maintain sufficient reserves to cover their liabilities. Specifically, adherence to the National Association of Insurance Commissioners (NAIC) Annual Statement Instructions and Accounting Practices and Procedures Manual (APAM) is paramount. These guidelines mandate that reserves be established on a sound actuarial basis, reflecting the best estimate of future obligations. Furthermore, the NAIC risk-based capital (RBC) requirements indirectly reinforce the importance of accurate reserving, as inadequate reserves can lead to lower capital levels and potential regulatory intervention. Ethical considerations also demand that insurers do not misrepresent their financial position by artificially lowering reserves, which could mislead stakeholders and regulators. An incorrect approach that prioritizes speed over actuarial rigor would fail to meet regulatory standards. For instance, relying solely on historical averages without considering current claim trends or emerging risks would likely result in inadequate reserves, violating the principle of establishing reserves on a sound actuarial basis. This could lead to regulatory sanctions, including fines and increased scrutiny, as it demonstrates a disregard for the insurer's financial solvency. Another incorrect approach, such as using overly optimistic assumptions without sufficient justification or documentation, would also be problematic. Regulators expect transparency and a clear rationale for all actuarial judgments. Failing to provide this justification, or using assumptions that are not supported by data or industry best practices, constitutes a failure to comply with the spirit and letter of regulatory guidance, potentially leading to accusations of financial misrepresentation. The professional decision-making process for similar situations should begin with a thorough understanding of the relevant regulatory framework, including state insurance laws and NAIC guidelines. Professionals must then assess the impact of any proposed operational changes on the accuracy and integrity of loss reserving. This involves consulting with qualified actuaries and internal audit functions to ensure that any adjustments to the reserving process are actuarially sound and compliant. If there is any doubt about the regulatory implications or the actuarial validity of a proposed change, the default position should be to err on the side of caution and maintain robust reserving practices, even if it means foregoing immediate efficiency gains. Open communication with regulators and a commitment to transparency are also crucial in navigating these complex issues. Question 10. Compliance review shows that the actuarial department is proposing a significant increase in premium rates for a particular line of business, citing a recent spike in claims frequency. However, the proposed rate filing lacks detailed analysis of the long-term historical data and does not adequately address the potential impact of broader economic factors on future claims. Chief Actuary is considering two approaches: A. Proceeding with the rate increase based on the recent spike, with minimal additional justification, or B. Conducting a more comprehensive analysis that includes long-term historical trends, economic modeling, and a review of industry-wide data to support the proposed rate adjustments. Which approach is most consistent with regulatory expectations for sound rate-making and actuarial practice? Option A. Proceeding with the rate increase based on the recent spike, with minimal additional justification. Option B. Delaying the rate filing indefinitely until a perfect predictive model for future claims can be developed. Option C. Conducting a comprehensive analysis that includes long-term historical trends, economic modeling, and a review of industry-wide data to support the proposed rate adjustments. Option D. Adjusting the proposed rate increase based on anecdotal evidence from claims adjusters without formal actuarial analysis. The correct answer is C. Conducting a comprehensive analysis that includes long-term historical trends, economic modeling, and a review of industry-wide data to support the proposed rate adjustments. Explanation: this scenario is professionally challenging because it requires the insurance company to balance the need for accurate actuarial data with the potential for regulatory scrutiny and the impact on policyholder costs. The decision-maker must navigate the complexities of rate-making and reserving, ensuring compliance with the specific regulatory framework governing the Managing Insurance Operations Exam, CPCU 500. The core of the challenge lies in interpreting and applying these regulations to a practical operational decision, where a misstep could lead to financial penalties, reputational damage, or unfair pricing for consumers. The correct approach involves a thorough review of historical data, consideration of emerging trends, and adherence to established actuarial principles and regulatory guidelines for rate filings. This includes ensuring that the proposed rates are neither excessive, inadequate, nor unfairly discriminatory, as mandated by insurance regulations. The actuarial team must document their methodologies and assumptions meticulously, providing clear justification for any deviations from historical patterns or industry benchmarks. This proactive and transparent approach aligns with the regulatory objective of ensuring solvency and consumer protection, fostering trust and maintaining market stability. An incorrect approach would be to rely solely on recent, potentially volatile, data without adequate consideration of long-term trends or the statistical significance of the observed changes. This could lead to rates that are not actuarially sound, potentially resulting in inadequate reserves or excessive premiums. Another incorrect approach would be to ignore or downplay the impact of external factors, such as economic shifts or changes in claims frequency, on future loss expectations. This demonstrates a failure to apply sound actuarial judgment and could result in rates that do not accurately reflect the risk being insured. Furthermore, attempting to manipulate data or assumptions to achieve a desired rate outcome, rather than reflecting the true actuarial indications, constitutes a serious ethical and regulatory violation, undermining the integrity of the rate-making process and potentially leading to unfair pricing. Professionals should employ a decision-making framework that prioritizes data integrity, regulatory compliance, and ethical considerations. This involves 1. Understanding the specific regulatory requirements for rate filings and reserving in the relevant jurisdiction. 2. Gathering and analyzing comprehensive historical data while also considering relevant external factors and future trends. 3. Applying sound actuarial principles and methodologies with clear documentation of all assumptions and calculations. 4. Seeking peer review and expert consultation when necessary. 5. Ensuring transparency and justification in all rate filings and reserving practices. 6. Continuously monitoring and updating actuarial models and assumptions as new data becomes available. Question 11. Process analysis reveals that an insurance company is preparing to launch a new, complex life insurance product with several innovative riders. The product development team believes the product's unique features will appeal to a specific market segment. To expedite the launch, the marketing department proposes using preliminary marketing materials and providing a brief overview to the sales force, with the understanding that detailed training and final compliance reviews will occur shortly after the product is available for sale. Which of the following approaches best ensures compliance with regulatory requirements and ethical sales practices? Option A. Prioritize speed to market by releasing the product with minimal initial compliance review, assuming any ambiguities in marketing can be clarified through subsequent communications. Option B. Rely on the sales team's existing knowledge and their ability to interpret the product's features and benefits when communicating with potential customers. Option C. Conduct a thorough review of all marketing materials and sales training programs by the compliance department to ensure accuracy and clarity before the product is made available to consumers. Option D. Launch the product with preliminary marketing materials and a brief sales overview, addressing any compliance issues that arise based on consumer complaints or regulatory inquiries after the launch. The correct answer is C. Conduct a thorough review of all marketing materials and sales training programs by the compliance department to ensure accuracy and clarity before the product is made available to consumers. Explanation: this scenario presents a professional challenge because it requires balancing the insurer's desire to introduce innovative products with the paramount need to ensure those products are marketed and sold in a manner that is compliant with regulations and ethical to consumers. The core tension lies in the potential for new product features, while attractive, to inadvertently mislead or confuse potential buyers, especially if the distribution channels are not adequately equipped to explain them. Careful judgment is required to navigate this space, ensuring that the pursuit of market share does not compromise consumer protection. The correct approach involves a comprehensive review of the product's marketing materials and sales training programs by the compliance department before the product is launched. This proactive stance ensures that all communications accurately reflect the product's features, benefits, and limitations, and that sales agents are fully trained to explain these aspects clearly and without misrepresentation. This aligns with regulatory requirements that insurers must ensure their advertising and sales practices are not misleading, and that agents are competent to sell the products they offer. Ethical considerations also demand transparency and fairness in all consumer interactions. An incorrect approach would be to launch the product and then address any compliance issues that arise based on consumer complaints or regulatory inquiries. This reactive strategy is problematic because it risks significant consumer harm and regulatory penalties. It demonstrates a failure to uphold the insurer's responsibility to ensure compliance from the outset, potentially leading to widespread mis-selling and a damaged reputation. Another incorrect approach is to rely solely on the sales team's understanding of the product, assuming they will naturally convey accurate information to consumers. This overlooks the critical role of formal training and compliance oversight. Sales agents, while knowledgeable, may develop their own interpretations or focus on selling points that inadvertently downplay important caveats, leading to a breakdown in accurate disclosure. This approach fails to meet the regulatory obligation for insurers to actively manage and oversee their sales force's conduct. A further incorrect approach is to prioritize speed to market over thoroughness in the review process, believing that minor ambiguities in marketing materials can be clarified later. This underestimates the potential for even minor ambiguities to cause significant confusion and lead to consumer detriment. Regulatory bodies often view such oversights as a failure to exercise due diligence, especially when introducing new or complex products. The professional decision-making process for similar situations should involve a structured, multi-stage review. This begins with product development, where compliance and legal teams should be involved early to identify potential regulatory hurdles. It continues with the development of marketing materials and sales training, which must undergo rigorous review by compliance to ensure accuracy, clarity, and adherence to all applicable laws and regulations. Finally, post-launch monitoring and feedback mechanisms are essential to identify and address any emerging issues promptly. This systematic approach prioritizes consumer protection and regulatory adherence throughout the product lifecycle. Question 12. System analysis indicates that an insurance company is considering implementing a new AI-powered claims processing system to enhance efficiency and reduce operational costs. This system will process sensitive policyholder information, including medical records and financial data. Which of the following approaches best aligns with managing insurance operations under the CPCU 500 exams regulatory framework, focusing on key industry trends like technology? Option A. Implement the AI system with minimal oversight, relying on the vendor's assurances of compliance without independent verification of their security and privacy protocols. Option B. Conduct a thorough risk assessment of the AI system, ensuring it complies with all relevant state and federal data privacy laws, cybersecurity standards, and anti-discrimination regulations, and establish clear data governance policies before deployment. Option C. Focus solely on the cost-saving benefits of the AI system, deferring any detailed regulatory review until after the system has been fully integrated into operations. Option D. Prioritize the immediate implementation of the AI system to gain a competitive advantage, assuming that general data privacy best practices will suffice for compliance. The correct answer is D. Prioritize the immediate implementation of the AI system to gain a competitive advantage, assuming that general data privacy best practices will suffice for compliance. Explanation. This scenario presents a professional challenge for an insurance operations manager because it requires balancing the adoption of new technologies with established regulatory compliance and the ethical imperative to protect policyholder data. The rapid evolution of InsurTech, while offering efficiency gains and improved customer experiences, also introduces new risks related to data privacy, cybersecurity, and potential bias in algorithms. A manager must navigate these complexities to ensure the company operates legally, ethically, and competitively. The correct approach involves a proactive and comprehensive risk assessment framework that integrates regulatory requirements with technological advancements. This approach prioritizes understanding the specific data protection laws applicable to the company's operations, such as those governing personally identifiable information, PI, and sensitive health information, and ensuring that any new technology deployed has robust security measures and audit trails. It also necessitates a commitment to ongoing training for staff on data handling protocols and the ethical implications of AI-driven decision-making. This aligns with the regulatory expectation for insurers to maintain the security and confidentiality of policyholder information and to operate with integrity, as often stipulated by state insurance departments and federal privacy laws. An incorrect approach would be to adopt new technologies without a thorough review of their compliance implications. For instance, implementing a new AI-driven underwriting tool without verifying its adherence to anti-discrimination laws, or without ensuring it can be audited to demonstrate fairness, would be a significant regulatory and ethical failure. This could lead to discriminatory practices, violating fair treatment principles, and potentially resulting in fines and reputational damage. Another incorrect approach would be to prioritize cost savings or operational efficiency from technology over robust data security protocols. This exposes the company to data breaches, which not only violate privacy regulations, but also erode customer trust and can lead to substantial financial penalties and legal liabilities. A third incorrect approach would be to assume that compliance with general data privacy principles is sufficient without understanding the specific nuances of insurance data regulations, which often have stricter requirements due to the sensitive nature of the information handled. Professionals should employ a decision-making framework that begins with identifying the business objective for adopting new technology. This should be immediately followed by a comprehensive regulatory impact assessment, identifying all applicable state and federal laws and guidelines. Next, a thorough risk assessment of the technology itself, focusing on data security, privacy, and potential for bias, is crucial. This assessment should inform the selection and implementation process, ensuring that mitigation strategies are in place before deployment. Finally, ongoing monitoring and periodic reevaluation of the technology's performance against both business objectives and regulatory requirements are essential for sustained compliance and ethical operation. Question 13. Risk assessment procedures indicate that understanding the historical underpinnings of insurance operations is crucial for effective management. Considering the evolution of insurance practices and their impact on the development of regulatory frameworks in the United States, which of the following historical developments most directly shape the fundamental principles of actuarial soundness and solvency that are central to modern insurance operations management and its regulation? Option A. The expansion of insurance markets driven by the societal and economic changes of the Industrial Revolution. Option B. The establishment of Lloyd's of London as a hub for marine insurance and market innovation in the 17th century. Option C. The formalization of actuarial science and the application of statistical methods to risk assessment in the 18th and 19th centuries. Option D. The emergence of early mutual insurance societies and informal risk-sharing guilds. The correct answer is D. The emergence of early mutual insurance societies and informal risk-sharing guilds. Explanation. The scenario presents a challenge in understanding the historical context of insurance operations, specifically the evolution of underwriting practices, and how these historical shifts inform current regulatory expectations. Professionals must discern which historical development most significantly shaped the modern regulatory landscape for managing insurance operations. As mandated by the CPCU 500, exams focus on operational management within a U.S. regulatory framework. This requires not just knowledge of insurance history, but an understanding of its direct impact on the legal and ethical standards governing today's insurance industry. The correct approach recognizes that the development of actuarial science and its formalization through statistical methods in the 18th and 19th centuries was a pivotal moment. This scientific approach to risk assessment, moving away from anecdotal evidence and intuition, laid the groundwork for more objective underwriting, pricing, and solvency requirements. This directly influenced the subsequent establishment of regulatory bodies and frameworks designed to ensure insurers operated on sound financial principles, protecting policyholders. Regulatory frameworks, such as those evolving from early state-level oversight to federal influences, are fundamentally built upon the principle of actuarial soundness, which emerged from this historical evolution. An incorrect approach would be to focus on the early forms of mutual insurance societies or guilds. While these represent early forms of risk-sharing, their operational models were largely informal and lacked the scientific rigor that later became the bedrock of modern insurance regulation. Their evolution did not directly lead to the complex actuarial and solvency regulations that define current insurance operations management. Another incorrect approach would be to emphasize the role of Lloyd's of London in the 17th century. Lloyd's was instrumental in developing marine insurance and fostering a market for risk. Its historical significance is primarily in the development of insurance as a commercial enterprise and specific market practices, rather than the fundamental actuarial and solvency principles that underpin broad regulatory frameworks for managing insurance operations in the U.S. The regulatory focus on solvency and actuarial soundness, central to CPCU 500, stems more directly from later, more formalized scientific developments. A further incorrect approach would be to highlight the impact of the Industrial Revolution on the growth of insurance. While the Industrial Revolution undoubtedly spurred demand for new types of insurance and increased the scale of operations, its impact is more on the expansion of the insurance market rather than the foundational principles that shaped regulatory oversight of insurance operations management. The core regulatory concerns addressed by CPCU 500 relate to the soundness and fairness of operations, which are more directly tied to the evolution of actuarial science. Professionals should approach such questions by first identifying the core concept being tested in this case, the historical drivers of modern insurance regulation. They should then consider how each historical development directly influenced the principles and practices that are now codified in laws and regulations governing insurance operations. This involves linking historical events to their impact on actuarial science, financial solvency, and policyholder protection, which are the cornerstones of regulatory oversight. Question 14. The evaluation methodology shows that an insurance operations manager is reviewing a proposal for a new product line. The manager must determine the most appropriate strategic considerations for this product launch, given that the company is structured as a mutual insurance company. Which of the following considerations is most critical for a mutual insurance company when evaluating such a proposal? Option A. Maximizing immediate shareholder returns and stock price appreciation. Option B. Prioritizing the interests of external investors over policyholder benefits. Option C. Focusing solely on aggressive market share acquisition through aggressive pricing strategies. Option D. Ensuring the product enhances long-term policyholder value and financial security. The correct answer is A. Maximizing immediate shareholder returns and stock price appreciation. Explanation. This scenario is professionally challenging because it requires an insurance operations manager to understand the fundamental differences in ownership structure and governance between stock and mutual insurance companies, and how these differences impact strategic decisions and regulatory compliance. Misinterpreting these distinctions can lead to incorrect assessments of financial stability, customer rights, and operational priorities, potentially resulting in regulatory scrutiny or poor business outcomes. Careful judgment is required to align operational strategies with the inherent characteristics of each company type. The correct approach involves recognizing that a stock insurance company is owned by its shareholders, who elect the board of directors and have a vested financial interest in profitability. Decisions are primarily driven by maximizing shareholder value. In contrast, a mutual insurance company is owned by its policyholders, who have a right to elect the board and share in the company's profits through dividends or lower premiums. Operational strategies for a mutual company must prioritize policyholder interests and long-term financial security for the benefit of its owners. Therefore, when evaluating a proposal for a new product line, the manager must consider how that product aligns with the ownership structure and the primary beneficiaries of the company's success. For a stock company, the focus would be on market share, profitability, and return on investment for shareholders. For a mutual company, the focus would be on policyholder benefits, long-term solvency, and the potential for improved policyholder value. An incorrect approach would be to treat both company types identically when assessing strategic proposals. For instance, assuming that proposal to significantly increase dividend payouts to policyholders is automatically beneficial for a stock company would be a regulatory and ethical failure. Stock companies are obligated to their shareholders, and while policyholder satisfaction is important for retention, the primary fiduciary duty is to shareholders. Similarly, prioritizing aggressive profit maximization through cost-cutting measures that could compromise policyholder service or long-term solvency for a mutual company would be a failure to uphold the company's ownership structure and its obligations to its policyholders. Another incorrect approach would be to overlook the governance differences, such as assuming policyholder voting rights are equivalent to shareholder voting rights in all aspects, which can lead to misinterpretations of control and decision-making authority. The professional decision-making process for similar situations should involve a systematic review of the company's legal structure and ownership. This includes understanding the governing statutes, articles of incorporation, and bylaws that define the rights and responsibilities of owners, shareholders, or policyholders, and management. The manager should then evaluate any proposed strategic initiative against these foundational principles, considering how the initiative impacts the primary beneficiaries and aligns with the company's long-term objectives as dictated by its ownership structure. Regulatory compliance is paramount, and any decision must adhere to the specific laws governing stock and mutual companies within the relevant jurisdiction. Question 15. The evaluation methodology shows that an insurance company is assessing its investment portfolio for year-end financial reporting. The portfolio includes a mix of U.S. Treasury bonds intended to be held until maturity, corporate bonds with fluctuating market values, and equity securities actively traded on major exchanges. The company's chief financial officer is considering different methods for valuing these investments to present in the annual financial statements. Which of the following approaches best aligns with U.S. generally accepted accounting principles GAAP for managing and reporting these investments? Option A. Value all investments at their original purchase price, as this represents the historical cost and is a stable measure. Option B. Value all investments at their current market value, recognizing all unrealized gains and losses directly in net income, regardless of the investment type or intent. Option C. Value U.S. Treasury bonds at fair value, corporate bonds at amortized cost, and equity securities at their original purchase price. Option D. Value U.S. Treasury bonds at amortized cost, corporate bonds at fair value with unrealized gains and losses recognized in other comprehensive income, and equity securities at fair value with unrealized gains and losses recognized in net income. The correct answer is A. Value all investments at their original purchase price, as this represents the historical cost and is a stable measure. Explanation. The evaluation methodology shows a scenario where an insurance company is preparing its financial statements and must account for its investment portfolio. This is professionally challenging because the valuation of investments, particularly those with fluctuating market values or complex structures, requires adherence to specific accounting standards and regulatory guidelines to ensure financial statements are accurate, transparent, and not misleading. Misapplication of these principles can lead to misstated financial positions, impacting investor confidence, regulatory oversight, and the company's ability to meet its obligations. The correct approach involves valuing the investment portfolio in accordance with generally accepted accounting principles, GAAP, as promulgated by the Financial Accounting Standards Board, FASB, for U.S. domiciled entities, which is the framework typically tested in the CPCU 500 exam. This means classifying investments appropriately, e.g., held to maturity, available for sale, trading securities, and applying the required valuation methods, e.g., amortized cost fair value. For instance, if an investment is classified as trading securities, it must be reported at fair value with unrealized gains and losses recognized in net income. This adherence to GAAP ensures comparability, reliability, and faithful representation of the company's financial performance and position, fulfilling regulatory requirements for financial reporting accuracy. An incorrect approach would be to consistently value all investments at their original purchase price, regardless of market fluctuations or their intended holding period. This fails to comply with GAAP fair value accounting principles for certain investment classifications, such as trading securities, and can materially misrepresent the company's financial health by not reflecting current economic realities. This violates the principle of faithful representation and can mislead stakeholders. Another incorrect approach would be to selectively recognize unrealized gains for investments that have appreciated in value, while deferring recognition of unrealized losses for investments that have depreciated. This selective recognition is a violation of the matching principle and the requirement to report all gains and losses for certain investment classifications in the period they occur, leading to an overstatement of net income and equity. A further incorrect approach would be to classify all investments as held to maturity solely to avoid recognizing market volatility in net income, even if there is no genuine intent or ability to hold these investments until maturity. This misclassification distorts the financial statements by understating risk and potentially overstating the company's financial stability, which is a direct contravention of accounting standards designed to prevent such manipulation. Professionals should employ a systematic process that begins with understanding the nature and intent of each investment. This involves consulting relevant accounting standards, e.g., FASB ASC 320, ASC 321, and internal investment policies. A thorough review of the classification criteria for each investment type is crucial. Subsequently, the appropriate valuation method must be applied based on the classification and current market data. Regular review and reclassification, if necessary, are also vital to maintain compliance. This methodical approach, grounded in regulatory and accounting principles, ensures accurate financial reporting and upholds professional integrity. Question 16. What factors determine the most appropriate actuarial reserving method for a newly introduced line of specialty liability insurance, considering the absence of extensive historical claims data? Option A. The method that relies on expert judgment and industry benchmarks for similar, albeit not identical, lines of business, combined with a conservative estimation approach. Option B. The method that assumes claims will develop at the same rate as the company's most mature and stable product line. Option C. The method that uses the simplest calculation, regardless of its actuarial validity. Option D. The method that produces the lowest reserve estimate to maximize current profitability. The correct answer is D. The method that produces the lowest reserve estimate to maximize current profitability. Explanation. This scenario is professionally challenging because it requires an insurance company to balance the need for accurate financial reporting with the inherent uncertainties in estimating future claims. The choice of reserving method directly impacts the company's solvency, profitability, and regulatory compliance. Careful judgment is required to select a method that is both appropriate for the specific line of business and consistent with regulatory expectations for financial soundness. The correct approach involves selecting a reserving method that is actuarially sound, reflects the best estimate of future liabilities, and is applied consistently. This method should consider the specific characteristics of the insurance product, the historical claims data, and relevant industry trends. Regulatory frameworks, such as those overseen by state insurance departments in the U.S., mandate that reserves must be adequate to cover all liabilities. Failure to establish adequate reserves can lead to financial distress, insolvency, and regulatory sanctions. The chosen method must also be transparent and justifiable to auditors and regulators. An incorrect approach would be to select a reserving method that deliberately understates liabilities to inflate reported profits or reduce premium requirements. For instance, using a method that consistently underestimates the ultimate cost of claims, perhaps by ignoring emerging trends or using overly optimistic assumptions, would be a regulatory failure. This practice violates the principle of conservatism and the regulatory requirement for adequate reserves. Another incorrect approach is to switch reserving methods arbitrarily without a sound actuarial justification. This lack of consistency can obscure the true financial performance of the company and make it difficult for regulators to assess solvency. It also undermines the reliability of financial statements. Professionals should approach reserving decisions by first understanding the specific risks and characteristics of the insurance portfolio. They should then evaluate available actuarial methods, considering their strengths, weaknesses, and suitability for the data at hand. A thorough review of historical data, industry benchmarks, and emerging trends is crucial. The chosen method should be documented, justified by actuarial principles, and consistently applied. Any changes to methodology must be supported by strong actuarial rationale and disclosed to stakeholders and regulators. This systematic and transparent process ensures that reserves are adequate, financial statements are reliable, and regulatory compliance is maintained. Question 17. Examination of the data shows that a core operational process for handling customer complaints within the insurance company may not fully align with current state insurance regulations regarding data privacy and consumer protection. The operations team has proposed a quick fix to update the complaint logging system to reflect the new requirements. Legal counsel has not yet been consulted on the proposed changes or the underlying regulatory interpretation. What is the most appropriate next step for the company to manage this legal risk? Option A. Implement a superficial update to the complaint logging system and monitor for any customer feedback indicating a problem. Option B. Wait for a formal inquiry from the state insurance department before taking any corrective actions to avoid unnecessary operational disruption. Option C. Immediately implement the proposed system update to demonstrate a proactive response to the potential compliance issue. Option D. Conduct a comprehensive review of the complaint handling process with specialized insurance regulatory counsel to assess the full scope of the regulatory requirements and develop a legally sound remediation plan. Correct answer is C. Immediately implement the proposed system update to demonstrate a proactive response to the potential compliance issue. Explanation. This scenario presents a professional challenge because it requires balancing the immediate need to address a potential compliance gap with the long-term implications of the chosen remediation strategy on operational efficiency and legal risk exposure. The company has identified a significant operational process that may not fully align with current state insurance regulations, specifically concerning data privacy and consumer protection. This creates a legal risk that could lead to regulatory fines, reputational damage, and potential litigation if not managed proactively and effectively. Careful judgment is required to select a remediation approach that is both compliant and sustainable. The correct approach involves a thorough, multifaceted legal review and a phased implementation of corrective actions. This approach is right because it prioritizes understanding the precise nature and extent of the regulatory noncompliance. It involves engaging legal counsel specializing in insurance regulation to interpret the relevant statutes and guidelines, assessing the operational impact of any proposed changes, and developing a remediation plan that addresses the root cause of the issue. This systematic process ensures that the corrective actions are legally sound, effectively mitigate the identified risks, and are integrated into operations without causing undue disruption. This aligns with the principles of proactive legal risk management and demonstrates a commitment to regulatory adherence. As expected under the CPCU 500 curriculums, focus on managing insurance operations within a compliant framework. An incorrect approach that focuses solely on immediate operational adjustments without a comprehensive legal assessment would be professionally unacceptable. This failure stems from a lack of understanding of the nuances of insurance law and regulatory requirements. Such an approach risks implementing changes that are insufficient to address the legal noncompliance, potentially leading to continued exposure to regulatory scrutiny and penalties. It also fails to consider the broader legal implications, such as potential contractual breaches or unintended consequences for policyholders. Another incorrect approach that involves delaying any action until a formal regulatory inquiry is initiated is also professionally unsound. This reactive stance significantly increases legal risk. It demonstrates a disregard for proactive compliance and the duty to manage operational risks effectively. Waiting for an inquiry often means facing more severe penalties and a loss of control over the remediation process, as the company would be responding under duress and potentially with less favorable outcomes. A third incorrect approach that involves implementing a superficial fix without addressing the underlying operational or systemic issues would be inadequate. While it might appear to offer a quick solution, it fails to provide lasting protection against legal risk. This approach neglects the fundamental principle of root cause analysis in risk management and is likely to result in recurring compliance problems, further increasing the company's legal exposure and operational inefficiencies. Professionals should employ a decision-making framework that begins with identifying potential legal risks, followed by a thorough assessment of the regulatory landscape relevant to the identified risk. This assessment should involve seeking expert legal advice to understand the specific requirements and potential consequences of noncompliance. Subsequently, a risk mitigation strategy should be developed, prioritizing solutions that address the root cause of the risk and are sustainable. This strategy should be implemented in a phased manner, with ongoing monitoring and evaluation to ensure its effectiveness and continued compliance. This systematic and proactive approach ensures that legal risks are managed effectively, protecting the organization and its stakeholders. Question 18. When evaluating the implementation of a new direct-to-consumer marketing campaign for a life insurance product, which risk assessment approach best ensures compliance with the NAIC Unfair Trade Practices Act model regulation and other relevant state insurance laws? Option A. Relying on the historical success of similar campaigns and assuming current materials will also be compliant. Option B. Waiting for customer complaints or regulatory inquiries to identify potential compliance issues in the marketing materials. Option C. Reviewing marketing materials for clarity and persuasive language, with final approval resting with the sales department. Option D. Conducting a comprehensive review of all proposed marketing materials and communication channels against NAIC model laws and applicable state regulations prior to launch, with input from legal and compliance teams. The correct answer is C. Reviewing marketing materials for clarity and persuasive language, with final approval resting with the sales department. Explanation. This scenario is professionally challenging because managing insurance operations requires a delicate balance between aggressive marketing to achieve business objectives and strict adherence to regulatory requirements designed to protect consumers. The core challenge lies in ensuring that marketing strategies, while effective, do not mislead, deceive, or unfairly target vulnerable populations. Careful judgment is required to navigate the ethical landscape and comply with the specific regulations governing insurance marketing. The correct approach involves conducting a thorough risk assessment of proposed marketing materials and campaigns by cross-referencing them against the National Association of Insurance Commissioners, NAIC, model laws and regulations, specifically focusing on those pertaining to unfair trade practices and advertising. This proactive review ensures that all communications are accurate, not misleading, and clearly disclose material information, thereby preventing potential regulatory violations and reputational damage. This aligns with the NAIC emphasis on consumer protection and fair competition within the insurance industry. An incorrect approach that relies solely on the sales team's subjective assessment of marketing materials fails to account for the nuanced and often technical nature of insurance products and regulations. This can lead to unintentional misrepresentations or omissions that violate unfair trade practice laws. Another incorrect approach, which prioritizes speed to market over regulatory compliance, risks launching campaigns that are non-compliant, potentially resulting in fines, sanctions, and a loss of consumer trust. Finally, an approach that only addresses regulatory concerns after a complaint has been filed is reactive rather than proactive, exposing the company to significant legal and financial repercussions and demonstrating a failure to uphold ethical standards of due diligence. Professionals should employ a systematic risk management framework. This involves identifying potential regulatory pitfalls in marketing strategies, assessing the likelihood and impact of noncompliance, and implementing controls to mitigate those risks. This includes establishing clear internal review processes for all marketing collateral, providing ongoing training to sales and marketing staff on regulatory requirements, and maintaining open communication channels with compliance and legal departments. Question 19. Governance review demonstrates that the claims department has implemented new automated workflows designed to expedite claim resolution and reduce processing costs. However, the review also highlights a potential gap in ensuring that all claim denials are thoroughly documented and communicated in strict accordance with the specific policy language and applicable state insurance regulations. Which of the following approaches represents the most appropriate risk assessment strategy for the insurance operations manager to address this finding? Option A. Focus on updating the claims processing software to better flag potential compliance issues, assuming that technological solutions will inherently resolve the documentation and communication gaps. Option B. Immediately halt all automated claim denial processes until a comprehensive, company-wide review of all claims handling procedures can be completed, which may take several months. Option C. Conduct a targeted audit of a statistically significant sample of recent claim denials to verify compliance with policy terms and regulatory requirements for documentation and communication, and implement immediate corrective actions for any identified deficiencies. Option D. Rely on the claims department's internal quality assurance metrics, which indicate a high rate of successful claim resolutions, to assume that denial processes are also compliant. The correct answer is C. Conduct a targeted audit of a statistically significant sample of recent claim denials to verify compliance with policy terms and regulatory requirements for documentation and communication, and implement immediate corrective actions for any identified deficiencies. Explanation: this scenario presents a professional challenge because it requires the insurance operations manager to balance the need for efficient claims processing with the absolute imperative of adhering to regulatory requirements and contract law. The challenge lies in identifying potential compliance gaps that could lead to significant legal and financial repercussions, including regulatory fines, lawsuits, and reputational damage. A thorough risk assessment is crucial to proactively identify and mitigate these risks before they materialize. The correct approach involves a systematic review of claims handling procedures against established regulatory frameworks and policy contract terms. This proactive stance ensures that all claims are processed in a manner that is both legally compliant and contractually sound, thereby protecting the insurer and its policyholders. Specifically, this approach aligns with the principles of good governance and regulatory oversight mandated by insurance regulators, which emphasize fair claims practices and adherence to policy provisions. The regulatory framework for managing insurance operations, as tested in the CPCU 500 exam, places a strong emphasis on compliance and risk management in claims handling. An incorrect approach that focuses solely on speed and cost reduction without adequate regulatory and contractual checks risks violating fair claims settlement practices. This could lead to allegations of bad faith claims handling, resulting in regulatory sanctions and litigation. Another incorrect approach that prioritizes internal efficiency over policyholder rights, such as delaying investigations or improperly denying claims, directly contravenes contract law and regulatory mandates designed to protect consumers. Furthermore, an approach that relies on outdated or incomplete legal interpretations of policy terms exposes the insurer to significant legal challenges and potential financial losses. Professionals should employ a decision-making framework that begins with understanding the specific regulatory environment and the terms of the insurance contracts. This involves conducting regular audits of claims handling processes, staying abreast of changes in laws and regulations, and ensuring that claims adjusters are adequately trained on both legal requirements and policy provisions. When a potential compliance issue is identified, the framework dictates a thorough investigation, consultation with legal counsel if necessary, and the implementation of corrective actions to prevent recurrence. The ultimate goal is to foster a culture of compliance and ethical conduct throughout the claims department. Question 20. Risk assessment procedures indicate that a significant, but not yet finalized, contingent liability related to a large, ongoing litigation case may result in substantial financial losses for the insurance company. The operations manager is aware that full disclosure of the potential magnitude of this liability in the upcoming quarterly financial statements could negatively impact the company's stock price and investor confidence. What is the most appropriate course of action for the operations manager? Option A. Reclassify certain operational expenses as extraordinary items to offset the potential impact of the contingent liability on reported earnings. Option B. Accurately estimate the potential loss based on available information and disclose it as a contingent liability in the financial statements, along with a clear explanation of the circumstances. Option C. Defer the full recognition of the potential loss to a future reporting period, arguing that the outcome of the litigation is still uncertain. Option D. Minimize the disclosure of the contingent liability, focusing only on the most certain aspects of the potential loss to avoid alarming stakeholders. The correct answer is B. Accurately estimate the potential loss based on available information and disclose it as a contingent liability in the financial statements, along with a clear explanation of the circumstances. Explanation. This scenario presents a professional challenge because it requires the insurance operations manager to balance the company's financial reporting obligations with ethical considerations and regulatory compliance. The manager is privy to information that, if fully disclosed, could negatively impact the company's perceived financial health, potentially affecting investor confidence and market perception. However, withholding or misrepresenting this information would violate accounting principles and regulatory requirements. The core of the challenge lies in interpreting the materiality of the information and determining the appropriate course of action in accordance with generally accepted accounting principles, GAAP, and relevant insurance regulations. The correct approach involves transparently and accurately reflecting the financial situation in the company's statements, even if it presents a less favorable picture in the short term. This aligns with the fundamental ethical duty of honesty and integrity in financial reporting, as mandated by regulatory bodies like the Securities and Exchange Commission, SEC, in the U.S., which oversees public companies and their financial disclosures. Specifically, GAAP requires that all material information be disclosed, and financial statements should present a true and fair view of the company's financial position. This approach upholds the principle of transparency, which is crucial for maintaining trust with stakeholders, including policyholders, investors, and regulators. It also ensures compliance with regulations that penalize misleading financial statements. An incorrect approach would be to minimize or omit the disclosure of the potential losses. This would be a violation of GAAP full disclosure principle and potentially the SEC's anti-fraud provisions. Such an action would be considered misleading and could lead to severe penalties, including fines and reputational damage. Another incorrect approach would be to aggressively reclassify expenses or revenue to artificially inflate current period earnings. This constitutes accounting manipulation and is a direct violation of accounting standards and regulatory oversight, undermining the reliability of financial reporting. Finally, attempting to delay the recognition of these losses until a future period without proper justification would also be a breach of accounting principles, as it misrepresents the current financial performance and position of the company. Professionals should approach such situations by first understanding the materiality of the information. If the potential losses are significant enough to influence a user's decision, they must be disclosed. The next step is to consult with the company's accounting and legal departments, as well as external auditors, to ensure that the accounting treatment and disclosures comply with all applicable regulations and accounting standards. This collaborative approach ensures that decisions are well-informed and defensible, prioritizing ethical conduct and regulatory adherence over short-term financial expediency.